Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get into it. Today, we're going to walk through a really timely piece of analysis. This is the U.S. market analysis for Friday, March 20th, 2026. And look at that subtitle, Breakdown Warning and Geopolitical Stress Test. That definitely tells you we're in for a serious discussion.
And just so we're all on the same page, this video presents a direct informational narration of the source document.
Okay, and we'll kick things off with the initial notice. It's really important to remember that this document is purely for informational and research purposes. Investing has significant risks, and you should always make your own independent decisions. Plus, the info we're about to cover can be super time sensitive and change without any warning.
So, here's how we're going to break it all down. We've got 6 key sections to walk through. First up is the market overview. Then, we'll dive into the geopolitical developments, unpack the growing energy and inflation crisis, and after that, take a close look at the turbulence in the bond market. From there, we'll lay out the outlook framework and wrap it all up with investment strategy.
Let's start with Section 1, the market overview. The big story here is a technical breakdown in the core indices and a pretty serious warning about something called a dead cat bounce.
So on March 20th, 2026, something pretty major happened in the U.S. stock market. It was a critical technical shift. Let's look at the specifics. The S&P 500, or SPY, it decisively broke below its key support level at 653, which put it into a technical breakdown. At the same time, the NASDAQ 100, that's the QQQ, fell below its 588 support, which really put a dent in growth expectations. And then you have the Russell 2000, or IWM, which is now down 10% from its peak, that officially confirms it's in a technical correction cycle.
So, what does all this mean? Well, the crucial takeaway here is that the source document is very clear. Any rally we see from here should be treated as just a technical rebound, what they call a dead cat bounce. And that's just a fancy term for a brief temporary recovery after a big drop. It is not a sign of a real fundamental reversal. You know those support levels we just talked about? 653 for the S&P and 588 for the NASDAQ? Well, now they've flipped and become hard resistance levels overhead. The report is really unambiguous here. As long as the Strait of Hormuz is closed, the fundamental picture for the market just isn't likely to change.
Now, let's move on to Section 2 and see how the geopolitical situation is feeding into this. The source calls this a parallel world contest and explains the hostage logic.
What's really wild is the chaotic information environment that investors are trying to navigate. Just look at this timeline from March 20th. It's a whirlwind of contradictions. At 3:48 p.m., you have Trump saying he could talk with Iran but doesn't want a ceasefire. Then, not even 2 hours later at 5:16, he's suggesting de-escalating military action. But then, an hour after that, at 6:19, the White House comes out and says the focus is on total victory. And just a few minutes later, at 6:25, Tehran is hit by bombardment. This is the parallel world state that investors are dealing with.
And this chaos brings us right to the heart of the problem, a classic chicken and egg dilemma. Should there be a ceasefire before they reopen the Strait of Hormuz, or should they reopen the strait before they even start talking about security guarantees? The strait has basically been taken hostage, and with it, the global economy. In an environment like this, the source says political talk becomes pretty much worthless. The only true anchor for investors to watch is the price of oil.
Which leads us perfectly into Section 3, the energy and inflation crisis. This gets into the huge structural shock that was triggered by Qatar declaring force majeure. And just so you know, that's a legal term for when crazy, unforeseeable circumstances stop a party from fulfilling a contract.
So energy prices are essentially the center of gravity for the global macroeconomy right now, and this table just perfectly illustrates how the length of the blockade is totally reshaping price forecasts. On March 20th, London Brent crude was at $106. But just look at these different scenarios. Saudi officials are projecting $180 if the blockade just extends through April. Meanwhile, Goldman Sachs and the IAA are forecasting an average of $120 if the blockade lasts for 6 months.
And it's not just oil. The damage to the liquefied natural gas, or LNG market, is huge. Attacks on Qatar's energy facilities have cut their export capacity by about 17%.
And that 17% drop, well, that translates into a massive annual production loss of around 12.8 million tons of LNG. Because of this, Qatar Energy has now officially declared force majeure on some of its long-term supply contracts.
Now get this.
The repair cycle is estimated to be as long as 3 to 5 years. The result is an annual loss of about $20 billion, and that loss gets passed directly into the cost burden of the entire global industrial chain. At this point, the upward shift in inflation expectations is pretty much considered irreversible.
And all of this flows directly into our next topic, Section 4, Bond Market Turbulence and the Monetary Policy Pivot. We're seeing a selling wave that is racing toward a 5% red line.
The global bond market is really at the center of this whole regime shift. Any fantasy the market had about rate cuts has been totally thrown out the window. What we're seeing is the U.S. 10-year Treasury yield accelerating upwards. The UK's 10-year gilt has hit its highest point since 2008, and the German Bund has climbed to its highest level since 2011. The market is now actually pricing in a 30% chance of a Fed rate hike in 2026.
And this brings us to a really critical warning about asset pricing. If the U.S. 10-year Treasury yield breaks through that 5.0% red line, the source warns that the market is likely to see a massive wave of speculative selling. And this wouldn't just crush the valuations of growth stocks, it could actually trigger a systemic credit rating crisis.
So where do we go from here? Let's look at Section 5, Framework for the Outlook. This part of the analysis gives us a time stress test based on the Strait of Hormuz blockade.
Time is really the most critical variable here because the risk of stagflation is moving from just a theory to something that's actually unfolding right now. So what could this mean for the S&P 500? Well, under a short-term blockade, we're talking less than 2 months, the projected bottom is around the 6,000 level. If we get a medium-term blockade of 2 to 6 months, that bottom shifts way lower to 5,500. And if this thing becomes a long-term blockade, lasting more than 6 months, the source says there is no clear bottom.
And finally, let's turn to Section 6, Investment Strategy and Single Stock Cases. This part focuses on things like company moats, their sustainable competitive advantages, as well as zeroing risk and governance crises.
In this kind of market, your holding cost is what really determines your psychological strength. The source gives us 2 great examples of core asset defense cases. For NVIDIA, the holding cost is incredibly low, at $79. That creates a really solid moat, even with the risk of the stock breaking below 115. Then you have Microsoft, with a holding cost around $180. For them, the area below 375 is actually seen as a zone to add more shares. This is then contrasted with a case like SMCI, which is considered a risk exclusion due to governance issues and had its coverage terminated.
And that all leads to this brilliant conclusion. The source leaves us with this really powerful thought. When investors see light inside a dark tunnel, they must determine whether it is the tunnel's exit or an oncoming train. So before that strait reopens, the advice is pretty clear. Cut back on trading frequency and just focus on the core indicators, oil prices, bond yields, and the duration of the blockade.
We'll close now with the full professional risk disclaimer notice. This document is for informational and research purposes only and does not constitute investment advice. The author is not acting as a registered investment advisor. Investing involves substantial risk, and any decision is undertaken solely at the reader's own discretion and risk. Past performance is not indicative of future results, and information may become outdated without notice.